Have you ever looked at the news and just felt completely lost? The economic headlines say one thing, but the market does the exact opposite. It's a super common frustration. And today, we're going to pull back the curtain and learn to see the market through the eyes of an institutional investor. Let's dive in.
It's the classic puzzle, right? You see reports that inflation is finally coming down, but for some reason, bond yields are still climbing. Or you hear that the Federal Reserve is aggressively tightening policy, pulling money out of the system, and yet the stock market is somehow rallying. What is going on here?
Well, here's the secret. We're not here to just explain the news. Instead, we're going to explain the market's reaction to it. We have to move past the headlines to understand the deep structural forces that actually drive prices. This is how the pros see the world. And it all starts with our first big concept, what I call the policy compass. You see, professional investors have learned a crucial lesson. The absolute level of interest rates is way less important than the direction they're headed. So what does that really mean in practice?
Okay, this slide really breaks it down. On one side, you have the policy level. Let's say an interest rate of 5.25%. That's just a number, a static snapshot in time. But what really matters is the policy direction. Are we expecting cuts, or are more hikes on the way? You have to remember, markets are always forward-looking. A high interest rate isn't necessarily bearish if everyone expects the next move is a cut. It's all about the change in expectations.
Now, data like this inflation chart, this is the input. This is the reason a central bank adopts a hawkish or restrictive stance to begin with. When inflation is running hot like this, it kind of forces their hand, right? This data informs the current policy level. But like we just said, that's not the whole story, not by a long shot.
And wow, this slide really puts that shift into perspective. On the left, you've got quantitative easing, or QE, where the Fed was expanding its balance sheet, basically pumping support into the markets. And on the right, the pivot to quantitative tightening, or QT, a complete 180. That massive shift in direction is the signal that forces every major investor on the planet to reposition their portfolios.
This focus on direction leads us right into our second major force, the supply of government bonds. I like to think of this as macro-gravity. It's this powerful, often ignored force that can either pull markets down or, when it eases up, let them fly higher.
So where does all this bond supply come from? Well, it starts with fiscal policy. Whenever a government spends more money than it brings in through taxes, it has to run a deficit. And to fund that deficit, it has to borrow money. How does it do that? By selling bonds. So more government spending means more bond supply is going to hit the market. Simple as that.
And it really just boils down to basic supply and demand. As this chart shows, when the government issues a ton more bonds, that supply curve shifts way out to the right. Now, to convince people to buy all that new supply, the price has to become more attractive. It has to fall. And because bond prices and yields are like a seesaw, when prices go down, yields have to go up.
But the big institutions, they go deeper. They use a framework just like this one. First, they look at the sheer size of the issuance and what kind of bonds are being sold. Second, and this is key, they track who's actually buying. Are the usual buyers like foreign central banks and pension funds still showing up? And third, they measure something called the term premium, which is basically the extra pay investors demand for the risk of holding a bond for a really long time.
So here's the crucial point, the big myth buster. You can have inflation falling, which should be good for bonds, but if the government is simultaneously flooding the market with a massive supply of new debt, that pressure can keep yields stubbornly high or even push them higher. It's a huge deal.
This brings us to our third big idea. And honestly, this is one of the most common traps for investors. We have to distinguish between just the raw amount of money in the system and what actually encourages people to go out and take risks.
Which brings us back to that nagging question from earlier. The Fed is doing quantitative tightening. They're supposed to be making things harder for the market. So why in the world are risk assets like stocks sometimes able to rally right through it?
And if you look at the data, the puzzle is very real. This chart clearly shows the Fed's balance sheet has been shrinking. They are, in fact, draining cash from the financial system. This isn't a theory, it's actually happening. So what gives?
Okay, here's the answer. We have to understand the difference between liquidity and financial conditions. Liquidity is simply the amount of cash floating around. It just answers the question, is money available? But financial conditions, they measure how easy and cheap it is to take risks. They answer a totally different question. Is the market rewarding you for taking risk, or is it punishing you?
So financial conditions isn't just one thing. It's a cocktail of several key market prices. It includes bond yields and credit spreads, which tell you the cost of borrowing.
It includes how the stock market is doing and how much volatility there is, which gauges investor confidence. And it includes the strength of the US dollar. All of these things together tell us whether the overall environment is friendly or hostile to taking risks.
And here is the punchline. During those times when stocks rallied, even though the Fed was tightening, it was because this index of financial conditions was actually easing. Maybe corporate borrowing costs fell, or market volatility collapsed. The point is, even as the Fed was draining liquidity, the overall market environment for taking risk was getting better. That is the key.
Okay, so let's put all these pieces together. By combining these concepts, the policy compass, macrogravity, and financial conditions, we can start to identify the dominant market regime. And that's exactly what the pros do to navigate these powerful forces.
This table is basically your cheat sheet. A bullish regime, one that's good for risk assets, usually has easing financial conditions, falling real yields, that's your return after inflation, a controlled bond supply, and a friendly central bank. A bearish regime? Well, it's the exact opposite. Tightening conditions, rising real yields, tons of bond supply, and a hawkish central bank. It's how these forces combine that really sets the trend.
So if you're looking for a simple mental model to take away from all this, here it is. Monetary policy from the central bank, that sets expectations. Fiscal policy from the government, that sets the supply. Liquidity is the fuel in the tank, but it's the broader financial conditions that actually decide which direction the car is going to go.
Ultimately, what this all means is that markets don't just react to a single data point in a vacuum. They move when these larger structural constraints, things like policy, supply, and financial conditions, start to shift, forcing money to flow from one place to another. A piece of data only matters if it confirms or breaks the existing story about these bigger forces.
So, the next time you see a headline that just doesn't seem to match what the market is doing, you'll be ready. You can move beyond asking, what's the news? And you can start asking the real institutional question, where are the constraints shifting? And that will give you a much clearer map of the forces that are truly at play.